So in this video, we're going to be looking at Apple stock and why, in my opinion, you should not be buying Apple stock at this current point in time. So if we look at the year to date of Apple, it's currently trading at 148.71, which is 18% down year to date, which is absolutely insane for a massive company like Apple. Now, a lot of people are saying because it's down by 18%, we should be buying the dip. And I don't disagree with buying the dip dollar cost averaging strategies. However, what I look at is understanding is what is the intrinsic or fair value of Apple before I look to buy and see an 18% discount. Because we've seen stocks like Facebook, Tesla that are down 20, 30, 40%. And why aren't we buying those stocks instead? Right. So we need to be looking at this at a more objective way to understand is should we be buying Apple at 148.71, even though it's been off its lows, it went as low as 137. But I'll show you why I think even 137 is not the price to be buying Apple. So the way we're going to do this, we're going to be using a discounted cash flow valuation model through Guru Focus. If you get a free account, you can do this. You don't need to pay to get to this screen. I'll link this actual link down below so you guys can head straight there and you guys can play around with these numbers, right? And what we're going to do, we're going to look at a free cash flow method and an EPS method as well. And what this model basically does is it forecasts what you think the growth rate is going to be for free cash flow, which we'll do first, and then we'll do earnings per share. And then it calculates your discounted rate back to the present day to calculate the fair value price. Now, if that sounded quite complicated, this calculator does it all for you. So let's just concentrate on the numbers. So the inputs we're putting in is the first thing we need to look at is what is the discount rate. And the discount rate, effectively what it is what is the ideal rate of return over the long term I want to get on the underlying asset. So in this example for Apple, I've gone with the discount rate of 10%. And the reason why I've gone with 10%, well, normally I would go with something higher, but this will prove my case, right? Because you can invest in the S&P 500 or Nasdaq, which historically will give you between 8 to 10% returns over the long term, and they have Apple included, right? So Apple is in within those indexes, so therefore you're already buying Apple as a default of buying those indexes. So if we were to invest in one single company, i.e., like Apple, even though how great Apple is, I would want to get a return higher than 10%. Ideally, I like to use 12.5%, but we'll go with 10% for the sake of the argument for this exercise, right? And then the next thing we need to do is understand over the next 10 years, what do we expect Apple's free cash flow to grow at? And then for the 10 years after that, what is the growth rate? And we've just used 4%. It's meant to be at the rate of inflation. Inflation's a lot higher, but I don't think inflation will be at the 8% wherever it is now. It'll be a lot lower. So the default setting is 4%. So I'm quite comfortable with that. So if we first look at a 13.9% growth rate, now where has that come from? That has come from the default setting in Guru Focus, this DCF calculator. It takes the previous 10 years of Apple's annual compounded growth rate. So over the last 10 years, Apple's free cash flow has grown 13.9% every single year. Now, the question you've got to ask yourself is, do you think Apple is going to continue growing its free cash flow by 13.9% every single year for the next 10 years? Personally, I don't think it will because of the nature of how Apple is. Apple's a beast, right? It can't keep growing at these aggressive rates every single year forever. It has to slow down at some point. However, for the sake of this argument, and to prove my point, let's assume that it does grow at 13.9% for the next 10 years. So when you calculate those two inputs of 10% and 13.9, it then calculates a fair or intrinsic value of 149.31, which is just less than a dollar over under the current stock price, right? So what this is basically saying is Apple is basically, if you believe in these inputs of a 10% discount rate and a 13.9% growth rate, Apple is currently at fair value. However, if that means it's a fair value to buy the stock, and we go buy the stock today, as soon as it goes to 150, 155, it's considered overvalued. So in those examples, we should be looking to really sell our position because it's going over the value. So what we want to do as a value investing approach is to get a large margin of safety over here so that we are buying the stock at a discount for it to grow into its fair value over the long term, right? So that's what we want to see, and that's kind of not what we're seeing over here at this current point at that price. So the next question then is if we don't believe in the 13.9% and we're going to stick with the discount rate of 10%, what is a more realistic growth rate for Apple? And when you do this, you really want to play worst case scenario because it's your money you're investing in, and the other side of the fence is always the S&P or Nasdaq ETF index funds like SPY or QQQ, right? So what you can do is you can head over to Yahoo Finance. If you type in the ticker symbol and go to the analysis section, and you scroll down to the bottom, it's got the growth estimates for the next next 5 years even. So we're going to extrapolate this out for 10 years. And yes, this is EPS estimates, but Apple is such a large company, their EPS and their free cash flow is roughly around the same in terms of their growth, right? So if we go with the 9.91% now, you'll see 9.91. So we're decreasing the growth rate. So the fair value of Apple will decrease because they're going to grow smaller than the 13.9% that we originally went for at 114.94. But so if Apple gets to 114.94, that basically if Apple drops, we still got around like 30. We want to really be looking at buying Apple around or below 114.94, right? So that is the free cash flow method. If we go to the EPS method, and again we use the 9.91, you can see it's around 110, and you can see there's not much difference between the two, and the reason is because you'll see over the long term their EPS is 6.16 and their free cash flow is 6.39. So their free cash flow and their earnings are quite similar. So you can use analyst estimates as part of growth rates. Now, I don't like using analyst estimates because they tend to overinflate these things for their own personal gain, for their price targets and various other things. So what I like to do is use a 12.5%, as I mentioned before. We'll do that for EPS as well, just to get a bit more margin of safety inside there. And you can see we now have a fair value of $90 to $94, right? So really, at the worst case scenario, we should be buying Apple around between the 90 and 94, and more than likely we should be buying below that price to give us that cushion and that growth for Apple to go into for that. Will Apple get to below $100? I don't know. Inflation fears, recession fears, all these different things, right? Apple has already dropped 18%. No one would have imagined Apple dropping 18%, right? In this example, it has to drop, a lot more than 18% to get anywhere near that price. So what I like to do is try to make money off of this, off of Apple, while I'm waiting for that price. And the price may never get to there. And that's okay. There's two reasons for that. One, there are thousands of other stocks out there. Apple is not the be all and end all of stocks to invest in. And secondly, if you trade options like I do, we can benefit and earn a little bit of money while we wait for Apple to eventually get to around these levels. Now, Apple is not a very volatile stock, so let's have a quick look at the options chain. So what I'll like to do is sell options. So if we go a month out, today's the 8th of June. We'll go, let's go the 8th of July. Let's go a month out. And Apple has to drop by a lot to get to these numbers here. So if you look over here, even at the 195, you're looking at 6 cents, so $6, $7 in terms of premium, right? However, in saying that, again, this is what I like to do is, you know, between 195, I don't mind owning 100 shares of Apple. However, do I believe in a month's time Apple will drop to 115? Probably unlikely. This will probably take, if we were to go into a recession, apologies, and Apple was to drop, it'll probably be a slow decline because it's taken, what's that, 4 months or nearly 6 months now to drop 18%. It might take another 6 months to drop again another 20%. So, so in a month's time, even if it does get to 115, I can sell covered calls on this. I can do a lot of other things to make more money on Apple. So it's not the end of the world owning Apple at 115. But then at least then I can make $24. It's not the best use of my capital, but again, I am on margin and various other things. So I only need a little bit of buying power to go achieve that $24. So that's what I would like to do is, once Apple gets to an attractive price, is start selling puts on this to generate premium. If it clips it and I get assigned, I get assigned. But in the short term, again, my personal view is Apple is again significantly overvalued, even at $148, because I just don't think it's going to get to we don't have enough margin of safety at the moment. So love to hear your thoughts if you love Apple or if you own Apple stocks or if you're aggressively buying Apple stocks at the current price or around the 150 mark. Appreciate if you like, comment and subscribe, and there's some more videos on there of various other things around options and discounted cash flow, and I shall see you guys in the next video.